This is Before and After from Refinitiv. I'm your host, Johanna Botta. This Friday, we'll see the release of the Michigan Consumer Sentiment Index. This number is released once a month by the University of Michigan and will give the market an instant gauge on the resilience of American consumers, given the perceived rise of geopolitical risks. The consumer sentiment figure is obtained from a 50-question survey of 500 Americans, giving their assessments based on 5 key sections. Personal financial situation now and 1 year ago. Personal financial situation 1 year from now. Overall financial conditions of business for the next 12 months. Overall financial condition of business for the next 5 years. Current attitude towards buying major household items. So even though this indicator is a survey, it will be hard to build a bear case on the economy unless this figure is well below predictions. That being said, with 70% of the economy consisting of consumer spending, it's worth paying close attention. The Michigan number is unique because it involves very specific questions, which means we can glean a lot of useful information about the psyche of American consumers and business owners. It can also be a stark reminder that market sentiments can at times be disconnected from the consumer sentiment. In recent years, the two have tracked pretty closely. In fact, the sentiment number and the S&P have risen in tandem since a low of 2008. The bottom line, one key area to look at and pay attention to is the expectation for inflation among consumers. Last month, we saw them set a record low with their 5-year expectations, which came in at 2.2% annual inflation. It will be interesting to see if even lower expectations appear this time around. That's because low inflation expectations could forecast a willingness among investors to be long on bonds, even at a time when relatively low yields continue to prevail. And if we see another record or a near record low, then one would expect this to lead to gains in the TLT. If that doesn't occur, though, we could use the market's inability to rally as a sign that the long bond easy money days are behind us, and we could be looking at some choppier moves in bonds this year. Schlumberger, one of the world's top oil services companies, is reporting its earnings in the coming days. 2020 has already seen an entire year's worth of geopolitical drama in the first 2 weeks. So it's safe to say that crude oil and the companies that depend on oil prices will be at the center of market discussions and also help drive broader market performance. With operations in 85 countries, Schlumberger is truly an international operation unlike any other. And it's that broad operation that could be a strength this earnings quarter. The boom of U.S. shale production has transformed our understanding of what constitutes oil inventory equilibrium. Nowadays, long-term spikes in the price of crude oil are vanishingly rare, despite increased geopolitical risk that once upon a time would have been very bankable. That has left investors gun-shy about committing large amounts to the oil services sector, and in return, we've seen these stocks continue to lag. Just last week, Schlumberger came out to talk down expectations for shale production in 2020. They also used $55 a barrel as a bare minimum for any new production growth. Under that number, and you'll actually see less U.S. production according to them. But is this tempered talk a sign for how the quarter will look? The bottom line, investors still have a lingering bitterness towards oil drilling companies, and we've seen how the fortunes of large-cap oil conglomerates fare much better with any crude oil rebound. Given the expected shale slowdown, could now be the moment that Schlumberger stock catches up with the XLE after 2 years of lagging behind? If they can show that they are expanding in growth segments of their business and tightening costs, any uptick in forward guidance could create a nice bounce. But of course, this is all dependent on crude staying north of the 55 level. Just 2 years ago, Schlumberger's share price was hovering in the $70–$80 range, with oil trading near 60. Today, it's over 40% cheaper. Goldman Sachs had the unenviable task of following J.P. Morgan's record-breaking quarterly earnings report, which was driven largely on the back of a massive increase in fixed income and FX trading. In the end, Goldman also had great trading results. But the FIC division of Goldman is much smaller than that of JP Morgan. This was reflected in the reported $1.7 billion FIC revenue compared to the $3.4 billion for JP Morgan. Lingering legal charges also hurt Goldman's earnings per share this quarter, which came in below expectations at 4.69. And although the bank's top-line number was a beat, 9.96 versus an estimate of 8.56 billion, the stock sold off pretty much instantly. The sell-off can be partly attributed to the surprisingly heavy legal fees of over 1 billion. And naturally, investors will want to know just how deep the rabbit hole of litigation might go. However, we should not discount the need for instant investor gratification when it comes to the new growth sectors David Solomon is building. But if Goldman Sachs is still lagging behind JP Morgan, even when its trading is firing on all cylinders, then some investors might well start to question the overall business strategy. So there it is, Michigan consumer sentiment and Schlumberger's earnings in the before, and Goldman Sachs results in the after, Refinitiv data throughout. This has been the Friday episode of Before and After. Please be sure to like, subscribe, and hit the notification bell. Share us with your friends, and we'll be back on Tuesday.